I'm sure the folks at Chase and the folks at Amazon today will have all kinds of things to say about this conversation. But yes.
Hello and welcome to In Control, where we learn about the finance of everything. I'm Tash, your host, and I'm also the CEO and founder of Cable, which supports the show. When I lived in England, I would pay for almost everything on my debit card. Meals out, a new pair of shoes, a ticket for a show, all on my debit card. The only things that made it onto my credit card were really, really big expenses. And when I first moved to the US a couple of years ago, I was amazed at how everyone puts everything on credit cards. The average American has more than 6K in credit card debt, and the average Gen Zer, those between 18 to 28-ish, they have more than $3,000 of credit card debt. Now that I've lived here a while, my primary card is, of course, my credit card. I'm definitely interested in optimizing my points. How can I get those free flights? Is cashback better than airline miles? And I honestly can't work out if this is just really good marketing or if there are actually advantages to using credit cards, despite the risks of high interest fees and growing debt. And so I want to understand credit cards from all angles, from the bank point of view as well as the consumer point of view. And I want to understand what the implications are of President Trump's proposed 10% annual cap on credit card interest rates. To do that, I am speaking to a true credit card expert. Susan Ehrlich has run credit card divisions for Citibank, Washington Mutual, Sears, and Amazon. She was president of financial services at Sears and HR Block, CFO at Simple Finance, and CEO at student lending fintech Earnest. She has served on the boards of Arrived Homes, BECU, the third largest credit union in the US, the Financial Health Network, Petal Card, and Finwise Bank. Susan is now a partner at Core Innovation Capital. Wow. What experience. Susan, thank you for chatting with me today. And I guess the question that we start with has to be, what is your primary credit card?
Tasha, thanks for having me. I have to say, I am not the optimizer that you are with credit card. I have been in this industry for about half the length that cards have been around in the United States. So it's been a while. And I will admit that my two main cards are my BECU credit union credit card and my Amazon 5% card, which is a product that I worked on and launched when I was at Amazon, over 10 years ago.
Oh, that's fascinating. So that's a cashback card, right?
It is. It's 5% back. I don't know why anybody would shop on Amazon and not use the Amazon Prime card. It is by far the only way to shop at all those Amazon outlets and businesses.
Okay, we are definitely going to get to credit card points and cashback because that's a whole thing I want to understand. But let's really build this up for our listeners. I want to understand the finance of credit cards. Let's start with the finance of credit cards from the bank's point of view. Please just explain to me, how do credit cards make banks money? What are the costs involved? Let's really get down to the basic fundamentals of credit cards from the bank side.
Yeah, I think it's fascinating. If credit cards, they really haven't been around that long. Like I was saying, it's been about 75 years that cards, the way they currently work, have really been in existence. We can kind of talk a little bit about that history. They are by far the most popular bank product in the United States, for sure. And they also happen to be one of the more profitable ones for banks, which I think is important, right? So, the experience of using your card, right? You're going to go into a merchant. You're going to try to make a purchase. You're going to present them with your card. They're going to swipe it in some way, shape, or form. That's going to send a message about that transaction to the merchant's bank, who's going to forward it along to a payment network, a Visa or MasterCard, who's going to pass it along to your issuing bank. And they're going to check and see, are you a card member in good standing? And do you have enough credit line for the purchase, right? So if all of those things check out, that's going to be an approval. You're going to get your items bagged up and you're going to be on your way. And it's an IOU to that merchant that you're going to pay. And your bank, your issuing bank, kind of settles that transaction with the merchant. They get paid the next day. And that item goes on your statement. And at some point you get your credit card statement with the due date, and you decide if you're going to pay that transaction in full, or you're going to use some time to make that purchase and pay it off over time. So what's happening on the back end, as the bank that has issued you your card is looking at that. So that bank is making money on your card relationship in kind of three major ways. The first is interchange, what they call interchange income, swipe fees that are associated with just that purchase transaction itself. If you don't pay in full, the bank is going to earn interest income, your APR, times, whatever portion of purchases you didn't pay in full, so your balance. And then there's going to be maybe some other fees in there. Maybe there's an annual fee on your card because it's a really valuable rewards program, or, maybe you aren't always paying on time and you've incurred a late fee here or there, or something else. So I'd say there's kind of three major revenue lines there, revenue components.
If we just pause on those, the first one, the interchange, how is interchange different between credit cards and debit cards?
Yeah. So, there was a point in time where they weren't. And the merchants in the United States, filed a lawsuit, against the payment networks, which resulted in something known as the Walmart settlement. Because there was a moment in time where the payment network sort of considered them, of equal value, they would say, to a merchant. But merchants looked at it and said, but they really don't represent equal risk. And so we don't want these things tied together. We want to have interchange rates that really are related to the dynamics of those businesses themselves. There's no credit risk really in debit transactions. So why would we be paying the same fees? So that sort of disconnected in kind of the late 90s, early 2000s, I think, was that settlement. And so you wind up with these two different structures on interchange. And interchange for credit card transactions has just typically been higher. Interchange pays for the rewards that are in reward card programs. And so over time, as reward card features have gotten richer and richer, you've seen kind of an increase of what merchants are assessed in terms of interchange fees to help banks pay for that.
Interesting. So the interchange fees, they're higher than the debit card interchange fees because the merchants are carrying this risk of this is credit. There is some risk that we don't settle this money. We don't get this money back. Who sets those interchange fees? Is it MasterCard and Visa?
It is, that's been an ever changing situation too, right? So it is MasterCard and Visa. Those MasterCard and Visa used to be owned by the banks, right? Those used to be cooperatives. And then following the MasterCard settlement, where there was these huge liabilities associated with that settlement, Visa and MasterCard, the banks wanted to sort of separate themselves a little bit, kind of shield themselves a little bit from some of the liability of those interchange lawsuits. And so Visa and MasterCard became independent companies, and they are responsible for managing those interchange fee schedules, which are incredibly complicated and incredibly complex, and not very transparent, I would say. So, but that is the subject of another podcast entirely. I've worked on all sides of the credit card industry model. So I've worked on the issuing bank side, where I've been the net beneficiary of interchange revenues, and I've worked on the merchant card acceptance side at Sears and at Amazon, where I've been the party that's being charged those interchange fees, which are very difficult to control that expense from a merchant's standpoint.
Okay, that sounds like a whole other podcast that I need to do. So if anyone is an expert on interchange and MasterCard and Visa, let me know. We should definitely have that conversation. So the interchange fees being set by MasterCard and Visa, those pay for the rewards. They're higher than debit cards, and they can vary by different types of merchants, and presumably they just go up over time because life. Okay, so that's the first one. Then you've got the interest income. Explain for me how APR works.
Yeah, well, the annual percentage rate is what is charged on your balances when you don't make a payment and that balance revolves, as they call it. And so when you think about that rate on your card, like that's the rate you would pay on whatever balances you don't repay in a time period. When banks think about it, they think about that rate multiplied by something called the revolve rate, like what percentage of the customers are going to pay in full and what percent are going to carry a balance month over month. So they take that interest rate, the APR, they multiply it by a revolve rate, and that kind of gives them the interest income percentage. So what banks are earning is something, on average across their whole portfolio of customers is something less than what that APR is. It's APRs are running kind of 21 to 23% these days, and banks are earning 16 to 18% is kind of the number that shows up in their profit and loss statement.
Okay. And then you've got that third bucket, which is like some credit cards come with an annual fee, late fees, that kind of stuff. Yeah. Of those three income streams for credit card providers, how are they split? Is it 50% interchange? Like, what is the breakdown generally of the split between these three income streams?
Yeah, it kind of depends on how their customers use the card and where they've focused their business. When it's a rewards card program and a high featured rewards card, they're going to attract more of what you'd call transactors, right? People who are charging a lot on their card, paying it off in full, sometimes making payments before the bill is even due to free up credit line and make even more purchases. So that kind of a customer, it's going to be heavily weighted to interchange revenue, mm-hmm. and they're really not carrying a balance. Whereas there's the flip side, customers that maybe are a little bit lower on the sort of prime to subprime range, that are more likely to use the card as a financing vehicle and not be able to pay in full month over month, really want to take advantage of that revolving line feature. Then banks that focus on that segment of customers are going to earn more revenue from interest income than they will from interchange, because that credit line will be full, right? There won't be a lot of extra credit line available to make purchases to earn interchange. So most of the income will come from the interest income. But I would say the preponderance, the vast majority of revenue is earned on that interest income in general.
Okay, that's super interesting and certainly explains, the targeting different demographics with these credit cards. Something that's always kind of baffled me is those zero interest promotions. Move your debt to this credit card and you'll have zero interest for a year and there's no fees to set it up. Is the play there purely CAC? This is just a cheap way to acquire customers, and then the hope is that they forget and we get to charge them fees, or they continue to use our card. Is that the purpose of those zero interest promotional offers?
Yeah, I mean, I think, and you see them less and less, right? The laws and rules around these kinds of programs have changed over time to make it less attractive to banks to do that. Typically when they were offered originally, if it was in connection to a merchant, like we offered 0% on Sears cards back in the day, and other merchants do that same. You see them from Best Buy and Home Depot. And when those programs were first launched, they were true zero, right? They were really no interest. And they were really used as financing promotions to help sell televisions and washing machines and refrigerators. As the banks adopted it, it was more to what you describe, a promotional offer to make it attractive for you, help you save money in the short term, and kind of operating on the expectation that most people wouldn't be able to pay off the balances fully in the time where the promotion ran, and then those balances would reprice, and the bank would be able to earn back some of that promotional money over time.
Yeah. Okay. So that makes a lot of sense. We've got the three core revenue streams there for a bank with a credit card. What are the costs involved for a bank?
The costs? Yeah. So those really fall into kind of four buckets. Like the first is a cost of funds, right? The fact that your issuing bank paid the merchant for your transaction the day you walked out of the store, and then, they're collecting transactions and they're not billing you for some period of time that can be up to 30 days. And then your bill isn't due for another 21 to 28 days. And so they have that cost associated with they're financing you. But their cost of funding is pretty low. They're a bank. They've got access to the Federal Reserve. And so, that's their first expense, cost of funds. The second is the fact that, some of the customers they've lent money to use their credit card aren't going to pay them back. So that'll be what they would call charge-offs. There's some of those transactions may not have been legitimate charges. You didn't authorize that transaction, or somebody got access to your card, and there may be some fraud charges, fraud losses that they'll incur. They'll have reward expenses, right? All those if it's a reward card and they're giving you miles or cash back, they'll have reward costs associated with the card. And then they just have like operating expenses, right? They've got, they're marketing for new customers, they're issuing statements, they're processing payments, they're, handling customer service inquiries, either online or on the phone. And so, that those kind of make up the four components of costs that banks have.
And this space is super, super competitive, right? You can get a credit card from most banks, most credit unions, a lot of merchants, all these companies now. And those costs feel pretty substantial. Like the operating costs of a credit card, just knowing how much it costs to run a bank without a credit card, those are probably pretty high. But you said right at the top that credit cards are one of the most profitable products that banks have. So that's really interesting. Despite all of this fairly large cost base, they're still very, very profitable for the banks.
Yeah, banks think about it as a return on assets, right? This is, as they deploy, their own funding, what kind of a return are they generating on it? And so, the credit cards are, I'll say not a very old category. As we said, it's only been around for about 75 years, by far the most popular, right? 8 in 10 Americans carry a card, and by far and away, one of the most profitable lines of business for a bank. So banks are earning, somewhere between 2 and 4% as a return on assets, which may not sound really high, but, we are running $3.5 trillion through our credit cards on an annual basis, and balances outstanding are approaching, billions of dollars in balances outstanding. So, 2 to 4% on a very, very, very large number turns out to be a lot of money for banks.
Yeah. And what that 2 to 4% return on assets, what that means, let me know if this is right or wrong, is a bank that has, $5 billion in assets, which means that's the deposits that they've gathered from their customers that they're keeping in the bank. They are making 2 to 4% of that total asset base in revenue through this credit card and the lending and those other revenue streams they're making.
Yeah, I would think about it as, whatever proportion of those deposits, right, they have deployed in making loans and credit card, right? So it's the balances outstanding is the assets. So those revolving balances form that baseline of assets. And this is the return associated with those dollars. And 2 to 4%, they could be making mortgages. They could be making auto loans. They could be doing personal loans. There are other product categories that they may be involved in, lending to consumers. But when you rank stack all of those, the returns associated with credit cards come out on top of all of those options. They'd rather put an extra dollar of funding available into credit card businesses if they can.
Yeah. And I think you just clarified that I was incorrect. So if a bank has $5 billion in assets, which is all of the deposits they hold, it's not 2 to 4% on the $5 billion because they won't be lending out all of that. It's the amount that they're lending out that they make that money on. Got it. Okay. That's super helpful. Thank you. So that is really clear. We've got the revenue streams for them. We've got the costs involved. That is really easy to sort of understand for banks. What about for merchants? These co-branded credit cards, you mentioned Home Depot, Walmart has a credit card. How do those work? At what point does it make sense for a a merchant, a brand, to have a credit card?
Yeah, I think, well, merchants would benefit at the, at the smallest amount of sales, to have a card program of their own, to be able to offer a convenience, for a customer to be able to make a purchase, particularly if it's a larger sized transaction, as I mentioned, like you're replacing a refrigerator or you're buying a mattress. And it really just is a question of the scale, the economics of scale, whether or not a bank is going to be interested in creating a program, for a retail partner. And I think technology is going a long way, and you see a lot of fintech companies that are helping reduce the scale required. But I would say back in the day when I was working on these programs, most banks would say, if you don't have 1 million customers, we really can't build a business that would be big enough, to make it worth our while. And I think, fintech has taken the scale down significantly, but, you really, for it to be worth a bank's trouble to personalize and customize, their systems and a program, they need to know that this could be a material contributor to their business.
That makes sense. And that's why there are those credit cards that are like, these are the 15 merchants that if you spend at. So that's sort of aggregating to make it enough customers to make it worthwhile for the bank.
Yeah. And I think it's, when banks look to partner with a retailer, they're really looking for, how do I get reach? How am I reaching more customers than I would see otherwise? How many people are shopping at this merchant? So how many chances am I going to have to get in front of that customer while they're shopping or while they're at the point of sale, at the cash register, the checkout, to be able to show off my product, get them to apply, get them into the program. And so they want to see scale. They want to see a lot of eyeballs. They want to see a lot of customers walking through the door, to make a program worthwhile from their perspective.
Yeah. Okay. That makes sense. And then from the merchant side, are the advantages there of having a credit card? Presumably they get a cut of the interchange. So it's like they get a little bit of revenue that way. Is that right?
Yeah, I think, how I was thinking about it, when I worked and ran these programs, there's kind of a couple of dynamics that make it interesting. One is just, as I said, financing is important. I worked at Sears. Sears doesn't really exist anymore. It had one of the very first credit card programs in the United States, goes back to the 1940s, when cards first came on the scene. They launched the Discover card. So Discover card was an outgrowth of Sears's business. And while the retail side of Sears may not have worked really well, what Sears was really great at was financing and building financing portfolios, both for their own card program, and for Discover. And what they saw is, a lot of consumers even today would have a difficult time making a $400 purchase. And so if your, washing machine broke or your refrigerator was on the fritz and you had to come in and replace that, you're going to have a difficult time being able to fork over the cash to do that. So either, being able to offer a store card or a co-branded card that enabled a customer to make that purchase today, that was a real convenience, and it helped increase sales for the merchant. And that was important. It also then now creates a loyalty vehicle, right? So I can be able, I've got a means for, giving special offers to my best customers. And again, trying to motivate more of their purchases coming to me as the merchant. And so I think those are places where retailers see the bulk of the benefit associated with the program is just incremental sales activity, and they be able to complete a sale that they wouldn't have been able to otherwise. And yes, in return for that, working with their bank on a co-brand program, they usually, interchange on those transactions, usually waived. And then they do get, they're incented on a per account opened basis, so that they've got some skin in the game to be marketing the card program to customers. And, sometimes they'll get a percentage of the profitability of the program overall.
Okay, that sounds, super beneficial for the merchants then. That makes a lot of sense. So from their side, any merchant would want to do it. And from the bank side, they're looking for the merchants with enough eyeballs, enough coverage so that it actually makes sense for them to stand it up.
Yeah. And when they, and the profitability of the program, right? So the more that customer base is going to look, higher quality from a risk standpoint, so you think about the airlines programs that are business travelers, or you look at, the home improvement outlets where it's people making an investment in improving a home they own. All of these things are kind of risk measures that tell you that the people shopping in these locations are, lower risk of credit losses associated with higher profitability for the bank.
Yeah. Okay. And so we've done the banks, we've done the merchants. What about from the consumer side? Points aside, which we're going to talk about, what are the benefits of using credit cards? Is it just access to money that you might otherwise not have had at that time?
Yeah, I mean, I think the biggest opportunity is convenience, right? So it's the streamlining and simplifying what your shopping experience looks like when you're going online or going into a store. So I think convenience is the overwhelming benefit. I think flexibility on how and when you're repaying is also useful. I mean, even if you're paying in full, if you're paying in full, that's a free loan, right?
Yep.
And if you're paying over time, that's a convenience of not having to find all of those dollars and budget them to that first purchase. You can kind of pay it off over time,
Yep.
and then you've got the benefit of whatever loyalty or rewards program is kind of attached to the card.
Yeah. And I guess like on the pessimist's side, like the other angle of this, how big of a problem is credit card debt? Like, is this just a way for banks to make more money and consumers are just getting in more and more debt and that's just the way it is? Like, how big of a problem is the debt?
Yeah. So when I started working in credit card, which was a long time ago, Tasha, I looked at it as a program that was really doing a good in the economy. At that time, we were back in the days where we were just moving to using credit scores and scorecards for kind of approving credit. And so before then, you dealt with a banker who used a lot of judgmental underwriting. And to be honest, people like you and me would not necessarily always qualify for credit from banks. And so the advent of credit card really democratized access to borrowing from banks. And, so folks that had been excluded from the financial system in the United States really had access for the first time. And I think working in credit card in those early days, you could feel very good about hearing from people that they had qualified for their first credit card, or, they finally had a card in wallet and they would proudly show off whatever it was. And I think, that was different. Right now we're at the point where, as I said, like 80% of Americans carry a credit card and many of them have more than one. So now one could argue that we might be at capacity, right? We've expanded usage. We're kind of reaching the limits of where we are. And maybe in some cases with some consumers, we've pushed past that and we're encouraging spend and usage of credit card where it may be, not an overall social good. But I'm, personally, for the experience that I had in the space, proud of the work that we did in terms of making sure that people were mainstreamed into the financial system in the United States. And is it perfect? Absolutely not. Is it better than the alternatives that were available at the time? And I think even still, I would argue credit cards in general do more good than harm.
Mm-hmm. Yeah. And how does that compare? Or I guess what do the newer lending methods like buy now, pay later do to that model? Is that when you said, perhaps we've gone beyond that for some consumers? Is that you talking about newer lending methods like buy now, pay later? Or how do you think about those?
Well, I think it's more in the cases of the consumers who charge off, right? If you, I've worked quite a bit in that subprime space, and I've worked quite a bit on the collections side of credit card. And I've been at the Financial Health Network, and I'm sure you've had other guests on your podcast who quote the Federal Reserve. Most Americans can't come up with $400 to fund an emergency without having to go to friends or family to borrow or find some way to borrow. So a lot of consumers are paycheck to paycheck, which makes any disruption in their financial life difficult. And one of the things that's going to tip is going to be their ability to keep current on their credit card payments. And falling too far behind has disastrous consequences on their credit. And so, when you have populations of consumers that are really kind of on that margin, this product, can be a source for bad as well as for good. And I think those are kind of difficult situations to kind of judge. But it's not a perfect product, that's for sure.
Yeah. Okay. I think we really understand how all of this works from a finance perspective. So let's talk about the thing that I am still trying to wrap my head around, which is how credit card points work. So let's start with from the bank and the merchant angle. Explain how the rewards work, who gets paid, like points versus cashback. Explain all of this to me.
Yeah. So, I think points predate cashback in the launch of credit cards. So I think the very first airline miles card was American Airlines Citibank. And that product launched in 1981.
Oh, wow.
So that was the very first rewards program, I guess you'd say, rewards card. And then Discover Card launched, actually you and I are talking on February 6th. The Super Bowl is 2 days away. And Discover Card launched with Super Bowl 20.
Oh, okay. So 40 years. Yep.
Back in, 1986. And that was the introduction of cash back as a value proposition or rewards product. Yeah. So in and that American Airlines rewards program has been very, very important to the airline industry in general over the years. So in the case of a points program, the bank's earning that interchange from the merchant swipe fee, and they are partnering with an airline, most likely, or a hotel business or some other travel firm are usually the biggest points programs. And, when miles are earned, those banks are remitting dollars to the airlines and the hotel companies to pay for those points. I think when last I looked, I think airlines make something like $25 billion a year on airline miles, sales off of these loyalty programs. I think Delta has the biggest program right now. It's like $7 billion of revenue a year, like 20% of all the revenue that they make is associated with being paid for miles earned on rewards programs, primarily their credit card program. Same is true for United, same is true for American Airlines. So, there's points in time where these loyalty programs really prop up the airline industry. They're high margin because there's really no cost yet associated with them. They're like getting prepaid for flights that you may or may not take. And so it's a really great line of business for them.
Yeah, I interviewed Will Messina from GrailPay about payment networks, and we were talking about the Delta example and how much revenue they make from it. And I guess I hadn't clicked until now that during COVID, that was probably like their only revenue, right?
A lifeline. And it's been a lifeline for them at many times in those business cycles, right, where the certainty and durability of those dollars coming in that come from loyalty programs has really sustained them.
Interesting. Okay, so the bank behind the credit card, they are making their interchange fees, and they think that a way to attract more consumers to use their credit card, therefore they can make more money, is by partnering with an airline, partnering with United. And so they say, hey, United, do you want to launch this credit card with us? We'll pay you to give our customers points for their spending. And that's kind of how it goes. Is that it?
Yeah. I mean, I would look at these programs not dissimilar from like retail card program, right? American Airlines, looking to generate more business or more preference for their airline over United, and Delta launches a card program to give their customers and people who fly with them a benefit that others don't have or don't receive. And so it's as important and as lucrative as we talked about for that bank, for that merchant partner, the airline partner, as it is for the bank. And so, I don't know who led the conversation when Citi and American Airlines first sat down together, but it's been extremely lucrative, extremely profitable for both of them, over the course of time, and that program.
Yeah. Okay. And so then cashback was just presumably let's be a bit different. Instead of doing points, I'm a merchant, I'll give you cash back. So it was just another way to use that interchange revenue to attract customers.
And this one was launched by a retailer. So if you think about it being Sears that launched the Discover Card network, right? This was, what value proposition do they have? Well, it's turning that interchange revenue that is part of a network's revenue earnings, right, into a reason to give preference for spend at merchants where you're going to get that cash back. And, banks kind of like it better because they really don't owe an airline or a partner any money out of the program, right? They're sitting on all of that accumulated interchange and waiting for you to, claim your gift card or redeem it for merchandise or request it as a statement credit or pull it out in terms of cash. So they get to sit on that money and earn whatever additional interest or benefit from perhaps breakage. If you don't come back and redeem, your account closes or it goes inactive and you forget you have it, like that's found money for them.
And so in the example of the Amazon 5% cashback card, it's Amazon paying the 5% cashback. It's not the bank. So
it is the bank. So in the case of the 5% program, it is the bank partner who is funding it. They're not without going into a lot of the specifics on that program, it's being funded by interchange revenue being earned on that card off Amazon, as well as just the profitability that the bank partner is earning on the program in general.
Interesting.
It had been the case that Amazon was paying an interchange fee on their credit card program. And so when that card first launched, those dollars just got recycled into paying for part of that program. But obviously Amazon wasn't charged 5%, so it was closer to 2%. There's marketing fees that these programs, marketing funds, that these programs have. So, that was applied toward paying for the 5%. And then just over time, negotiating leverage between the two partners has put more and more of that liability on the banks versus the merchants.
I bet. Interesting. So as the merchant becomes bigger, and obviously Amazon being just a huge, huge merchant, so many small transactions as well, which goes to those interchange fees. Amazon has the power to try to negotiate that actually they are paying less of that 5%. They're bringing so many customers to the bank. They are enabling the bank to make so much revenue from the interchange, the interest income, those fees, that actually they're able to say, hey, bank, you got to fund more of this because we are bringing you so many customers. And that's just the power of the merchant in that situation.
Yes. And I'm sure the folks at Chase and the folks at Amazon today will have all kinds of things to say about this conversation. But yes, I would agree with you. It started as a shared expense
Okay.
between the bank and the merchant. And then as the program gets bigger and, depends who has the negotiating leverage at the time, right? That gets pushed around between them. But it's my understanding at this point in time, Chase is paying the overwhelming majority of the costs of that reward program.
Fascinating. And so stepping back and you said that you mostly use your Amazon cashback card and your BCU credit card with your credit union. Is it your kind of view, obviously no financial advice to anyone listening, that actually points versus cashback, it's pretty much the same, just basically whatever you fancy more of? If you fly a lot, go for miles. If you don't fly a lot, cashback. Do you see any benefit for a consumer to choose one over the other?
I am the worst person. You're going to have to get the points guy on.
All right. Maybe
question.
Maybe you can introduce me to a points guy or gal,
sure.
And I can dig into that with them. Okay.
For sure. I mean, for me personally, I see the 5% off. I shop on Amazon for nearly everything.
Yeah.
So earning 5% back. And it's so easy to just apply those points to pay for a transaction in the checkout flow on Amazon. That to me, that's just a no-brainer. If you're not carrying and using the Amazon card, particularly for your Amazon purchases, that's just, you're leaving money on the table that they would gladly give you if you applied for that card.
Yeah.
And with BECU, that was cash back. So if I wasn't using my Amazon card, then to get 2% cash back for using BECU and support my credit union, I'm happy to do that. So I am not a rewards optimizer, so I have no tips or tricks, hacks that you can apply to figure out where you can earn the most money, unfortunately.
Got it. Okay, that makes sense. I want to finish our conversation by trying to understand Trump's proposed 10% annual cap on credit card interest rates, because as a simple statement, consumers hear that and they think, well, that's great. But there's been a lot of chatter on my LinkedIn feed about actually why this might be detrimental. So explain this to me. Try to help me understand both sides of this proposal.
Yeah, without making any judgments on Trump as a politician or a president, you have to give him credit for being a person who knows how to own and control the news cycle.
Yep.
And in this case, I think he has dominated the news in this area. I think it was interesting to note, too, I'm a subscriber to This Week in FinTech. I'm guessing you probably are as well. And they just published their newsletter for the day. And the headline is "Credit cards are booming and no one cares about the rate cap." And I think that sums up in a nutshell my thoughts on this as well. You have to kind of start with what Trump said. And so I think the message has gotten garbled in the game of, telephone or translation that has occurred. So, Trump was at Davos. He made a statement that he called for banks to impose a 10% cap on credit cards for 1 year. So I think the time limited nature of that is important to understand. It also wasn't an executive order. It was just an announcement. So it doesn't carry any weight or authority, or certainly less weight and authority over something like an executive order. And he set a deadline, January 26th, 2026. And that day came and went.
Did anyone comply?
No banks complied. And as a result, he made an announcement suggesting that Congress should pass legislation to impose this rate cap. And as we all know, Congress is a dysfunctional mess. And so to kick the can to Congress is to, potentially put this thing on the scrap heap of history. And so you have to ask, well, what was he doing? Why did he do this? And I think the speculation is interesting. And I don't know the answer. I wasn't involved in it, but, you could certainly say, hey, did this go into the conversation as a comment on affordability and a statement that Trump could make to show that he was on the side of average everyday consumers and trying to fight the good fight on affordability and get a soundbite out there that he can return to. For sure. It ticks the box there for sure. I think it's interesting as well. Alex Johnson, Jason Mikula have also commented that, Trump and the administration were negotiating with the banks over the Clarity Act and crypto legislation at the time that Trump made this announcement. So was this him creating a bargaining chip to say, hey, I see that very profitable line of business you have over there. And if you want to keep it that way, I need you to give me something over here. And so did it play into, a negotiation that was happening at the time? I think that seems very credible, very plausible reason. But in terms of if we took it at face value, what would actually happen, if banks were required to impose a 10% cap? I think there, we have a colleague in the industry, Sean Buddy from Ensemblix, who's commented on this. He's like, price constraints don't eliminate risk; they just reallocate it. So for sure, I think what banks would most likely do is do everything they could to preserve the profitability of their programs. So, they're gonna open fewer accounts, right? They're going to be more attuned to who the profitable low risk customers are, where they could still make money if they can, with only being able to charge 10%. They're going to certainly strip away rewards and try to eliminate. That's a very controllable cost for them. So reward program benefits, I think, get reduced pretty significantly. And, anybody who's kind of at the lower end of the FICO range, a near prime or a subprime customer is certainly not going to get approved for credit. The risk of charge-offs are just too high in those customers to expect that they're going to continue to see a card. So, if their card comes up for expiration, it might not renew. If they try to apply for a new card, they might not get one. So I think you'd see credit card revert to where it was when cards first launched. And it would be, a very low risk, high transaction, upper income consumer that would still have a card. And most people would be pushed to look at a personal loan or buy now, pay later as an option for making purchases.
That's super interesting. So if it was ever forced, if this was a thing that was mandated for banks, it, whilst sounding like a great soundbite for affordability, actually has the exact opposite effect, probably long term.
Yeah, I think for certainly for a huge swath of people who are currently using cards today, they'd expect to see that product go away over time. They would see annual fees reimposed on them. Banks are going to move
the revenue stream elsewhere, basically.
100%. 100%. Yeah. Like it's, banks aren't going to, there's a lot of, if you think about like where we talked about that current interest income is at 16 to 18%. So, card rates are at 21 to 23%. You cut that in half, knock that down by that many basis points. Like banks aren't just going to take that, right? They're going to make it back someplace else. And so consumers will pay for it somewhere, either in not having access to the product or having the cost of that product be covered some other way.
Got it. All right. What have I not asked you about credit cards that you think is like fundamental to how they work?
Fundamental to how they work? Well, I think the history is really interesting. So I would recommend, if you are at all intrigued in this topic, there's a great book called A Piece of the Action by Joseph Nocera, who really walks through in a really easy to understand way kind of the history of card and where it began and kind of what it has evolved to today, which I think is great. So I don't know if you know that the very first credit card was launched in 1950. And it was the result of a businessman in Chicago going to a business lunch and forgetting his wallet and having the brilliant idea that wouldn't it be great if I could create a network of restaurants that would be willing to accept my card as a means for paying for my meals, and they could just bill me at the end of the month and I could settle. And so the first ever credit card program was the Diners Club, launched in Chicago in 1950. So from those very humble beginnings and from that very simple problem that he ran into, an entire industry and category that now generates $3.5 trillion of spend, which is more money than the GDP of the UK, the GDP of South Korea, was born. And I think that is just a remarkable trajectory for a business.
Do you know what his name was?
Frank McNamara.
Frank McNamara started the credit cards. Awesome. Susan, this has been so fascinating. I definitely feel like I understand so much more about credit cards. Thank you so much for teaching me all about it.
Thank you for having me on the show and giving me the opportunity to share what I know.
And if you're listening and you enjoyed this, please do share In Control with your friends and colleagues. And don't forget to subscribe on Apple Podcasts or Spotify. And we'll see you next week for another episode of In Control.